Ever notice how banks act differently depending on how much money you have? At one level, they charge you fees. At another, they send you gifts. Same bank, same building, completely different treatment. So today, we're going level by level, from broke to ultra rich. And you'll see why banks don't just store money, they rank people. Level 1. You're broke or close to zero. At this level, the bank doesn't see you as a client, it sees you as risk. Low balance fee, overdraft fee, maintenance fee, paper statement fee. The less money you have, the more expensive banking can become. You walk into the branch and nobody is rushing to greet you. You wait in line. You explain your situation. You hope they understand. But the system is not built around understanding. It's built around rules. Your card gets declined for a $5 coffee and the bank still charges you. To the bank, that mistake is revenue. You ask for help and they offer a secured credit card, which basically means, give us money so we can lend you your own money. You are offered products that protect the bank first, and if your account goes negative, the tone changes fast. Friendly emails become automated warnings. Customer service sounds polite, but the answer is usually no. Level 2. You're living paycheck to paycheck. Now the bank sees movement. Money comes in, money goes out. You are not rich, but you are active, and activity is valuable. The bank starts offering credit cards with catchy rewards. 1% here, 2% there. It feels like free money, but the bank is watching for one thing: interest. If you carry a balance, rewards become the bait, and the real profit comes from what you cannot pay off. At this level, banks sell convenience, mobile deposits, instant notifications, easy transfers. The easier it is to spend, the more useful you become. You get pre-approved messages, not because they love you, because the algorithm believes you might borrow. You are treated better than broke customers, but still inside the maze. Level 3. You have a small emergency fund. Now the bank starts to relax. You are no longer just risk. You are a stable customer. Maintenance fees may disappear if you meet minimum balance rules. Suddenly, the same account becomes cheaper, not because the bank changed, because your balance changed. You may get better credit card limits. You may get small personal loan offers. You may even get a slightly nicer tone from customer service. But do not confuse better treatment with loyalty. The bank is still measuring what you can produce. Deposits help them, credit usage helps them, loans help them. Your money has become more useful to them. Level 4. You are middle class with steady income. Now banks start competing for pieces of your life. Your home loan, your car loan, your credit cards, your investments. The bank wants to become your financial operating system. This is where relationship banking begins. They offer bundled products, special checking tiers, and mortgage discounts. But the discounts often require you to bring more money in. Keep $10,000 here. Move your paycheck there. Open this account. Every product makes the relationship harder to leave. The bank calls it convenience. Strategists call it stickiness. At this level, you get more respect, but still mostly standardized service. You might get a named banker, but not true private banking. If you call, you may skip some waiting, but not all. Level 5. You become an investor. Now the bank sees something more powerful than income: assets. Income is what flows, assets are what stay, and banks love assets because assets can be managed. This is when investment accounts enter the conversation. The bank might offer portfolio management, retirement planning, and advisory services. The language changes from fees to strategy. Suddenly, they ask about your goals, retirement age, risk tolerance, time horizon, legacy. That sounds personal, and sometimes it is helpful. But remember, advice can also be a product. Some recommendations make sense, others make more money for the institution. The more assets you have, the more invitations you receive. Market updates, webinars, free consultations, investment lunches. They are not just educating you, they are courting your money. Level 6. You are affluent. Maybe you have a high salary, strong savings, and a growing portfolio. Now you may be offered premium banking, better cards, higher limits, fee waivers, priority lines. For the first time, the bank may treat your time as valuable. You might get a dedicated relationship manager, someone who calls you, not just someone you call. This is a psychological shift. The bank begins to chase you because your balances are profitable. You may get invited to premium credit cards with serious annual fees, travel credits, lounge access, concierge service, metal cards. The benefits can be real. But so is the business model. At this level, the bank wants your deposits, your spending, and your investments, not one product. The whole relationship. Level 7. High net worth. This is where banking starts to look less like a branch and more like a club. You are no longer standing in line with everyone else. You get private bankers, wealth advisors, tax specialists, and estate planners. The conversation becomes less about accounts and more about structure. How should assets be held? How should risk be managed? How can money move efficiently across accounts, entities, and generations? The bank now uses words like customized, strategic, and bespoke. And yes, you may actually get better pricing, lower mortgage rates, reduced fees, better foreign exchange spreads, because at this point, the bank is competing to keep you. Your money is now portable, and everyone knows it. High net worth clients also unlock lending that ordinary customers rarely see. Instead of selling investments to buy something, they may borrow against them. That can preserve investments, manage taxes, and create flexibility. But it also adds risk, especially when markets fall. The richer the client, the more sophisticated the tools and the traps. Level 8. Ultra-high net worth. At this level, banks may not even feel like banks. They feel like advisory firms, family offices, and deal rooms. The bank wants to be close to the family, not just the account. Because wealth at this level is not a balance, it is an ecosystem. There may be operating businesses, real estate, trusts, foundations, and global accounts. The bank's job becomes coordination. They bring in teams, not tellers. Meetings may include lawyers, accountants, investment committees, and bankers. The products become more complex and often less visible to the public. Private credit, alternative investments, structured products, custom lending. Some are useful. Some are expensive complexity wearing a nice suit. Ultra-rich clients also get access to opportunities others never hear about. Early deal flow, private placements, exclusive funds. But access does not automatically mean advantage. Sometimes, exclusivity is just marketing with a velvet rope. The bank's tone becomes extremely careful. Nobody wants to lose a client who could move millions. Mistakes get escalated. Calls get returned. Problems get handled. Not because the rich complain better, because the financial consequences are bigger. Level 9. Billionaires and institutional scale wealth. At this level, the relationship becomes strategic for the bank itself. The client may bring deposits, loans, investments, companies, employees, and influence. Now the bank may assign entire teams to one relationship. Private banking blends with investment banking and corporate banking. Loans may finance companies, acquisitions, yachts, art, or real estate. Collateral might be stock, property, businesses, or rare assets. The bank is no longer just asking, "What is your balance?" It asks, "What can we build together?" That can mean access to capital markets, mergers, and global financing. The relationship is powerful, but not emotional. Banks are loyal to economics, not personalities. If the relationship stops making sense, the warmth can disappear. Now, let's zoom out. At the bottom, banks monetize mistakes. In the middle, banks monetize activity. Near the top, banks monetize assets. At the very top, banks monetize relationships and influence. This is why treatment changes so dramatically. It is not random. It is incentive-based. The bank's kindness often follows the size of the opportunity. Small balances get rules. Large balances get exceptions. Small customers get products. Large customers get strategies. Small customers are asked to adapt to the bank. Large customers may see the bank adapt to them. And that creates one of the strangest truths in finance. The people who most need cheap banking often pay the most. The people who least need perks often receive the best ones. That is not a moral system. It is a profit system. So, what can you do with this information? First, know which level you are in. Second, do not confuse attention with generosity. A friendly banker may still be selling a profitable product. Third, ask what the bank earns from the recommendation: fees, interest, spreads, commissions, assets under management. Fourth, use your growth as leverage. As your balance improves, negotiate fees, rates, and service. If the bank will not value your relationship, another bank might. Because your money is not just stored, it has bargaining power. The goal is not to impress banks, it is to understand them. Once you understand the game, you can stop being the product and start being the strategist.